Hey everyone, welcome to this week's Weekly Chat. Today I show you my real estate net worth, $3 million, but I'm not selling. You shouldn't either. Hey everyone, welcome to this week's Weekly Chat. And on this week, I was inspired because there's a wedding this weekend and there's people coming from out of town, and there's one particular individual, a very good friend of Kyle and mine. He's coming to town, and he had the opportunity to buy into condos. He's since moved to the States and is doing very well in the States, but he chose not to invest in Toronto condos because he didn't believe in the market. So, like good old university buddies, I use as an inspiration to put some information together, and it's really relevant to everyone watching the video wise. If you've been on the fringes, or even if you own some condos and contemplating selling wise, why you shouldn't and why you should keep on buying condos. So what I did is I actually calculated my net worth, my real estate net worth. And all this is just taking current market value less all outstanding leverage on the properties. And if I were to sell everything today, this is the number that I'd be left with, and I'd be left with $3 million. So my real estate net worth is $3 million if I sold off everything in my portfolio wise. I know Kyle, I said to Kyle, Kyle, do you know your net worth? Do you look at it? He's like, I look at it every day. I'm surprised you have to calculate that now.
Yeah, constantly calculating it. Every time a report comes out, the percentage, you got to factor that in, figure out where we're standing.
You can see where the difference is in personalities wise. But
now, hold on. Yeah. Just, you shouldn't be looking at it daily or calculating it because, again, real estate is a long-term game.
Exactly, and that's why I didn't know it, because that's
so you're practicing what you preach. I get it. I enjoy it.
You're an analytical person.
Yeah.
And that's true. And I actually said that to someone. I actually don't know what this number is. In a week or so ago, because I'm like, it's not really relevant. But it's relevant to today's topic because I wanted to show you what I've grown since 2012 with an initial deposit of $39,300. This was all grown on an initial investment and then using the equity on the properties to help grow and continue buying and then expand the portfolio. That real life monopoly, starting in Baltic Avenue and moving around the board. So having that first property and getting some appreciation on that property, leveraging that property, using that to buy more properties, and that's what I have today. So if I look at it, I shouldn't say it actually was all the initial investment property because I had my original condo that I purchased, but I bought that one with 5% down. So if we go through the story, bought my initial condo on assignment for 5% down in the Bohemian Embassy. So that cost me, I don't know what let's say it was $500,000 that unit. I think it was less, but just easy math, $500,000. So 5% of $500,000. $25,000 for my down payment on that, and then we have the $39,300, which was the initial investment condo. So if we do some quick math, that is 39 to 40. So we're looking at roughly $65,000, just a little bit less than $65,000. And I had those two properties, leveraged the Canary one to help buy some more investment condos, sold my principal residence Bohemian Embassy and used that money to buy my house. And then once I had the house, I used the appreciation in the house to rapidly expand my real estate portfolio. So again, using the leverage from multiple assets now to help get the down payment amounts to buy multiple condos. And that's how I was able to grow a portfolio today of the 11 condos, of the apartment building in Hamilton, of the triplex in High Park. And again, if I sold everything out, I'd net out to $3 million before tax. Now, am I selling? Kyle, am I selling?
Of course not.
No, I'm not selling. I'm not selling anything. And the reason I'm not selling is, again, what I preach is I don't care what it's worth today. I care what it's worth down the road. So we've done this exercise before. I calculated what my portfolio would be in 30 years. And the difference between this calculation and previous ones I've done is I've included the house and I've included the apartment building in Hamilton as well, my share in that investment.
All of your real estate assets.
All of the real estate assets, because everything. And I calculated what's that going to be worth in 30 years, because in 30 years they'll all be paid off and there'll be no mortgages on the properties. And my final number at a 3% annual compounded growth rate, nothing, extremely conservative level.
Yeah, that's nothing.
Nothing. But it allows for ups and downs periods, because
very conservative.
It allows the bears in the market. This is what the net out value would be $20.7 million. So in 30 years, by doing, again, nothing, just renting out the properties, my portfolio will be worth $20.7 million. And again, this is not even factoring in any cash flow from the rental payments, just strictly from appreciation wise, $20.7 million.
That's crazy.
And that's just by boring compounded interest. And I know Kyle loves compounded interest.
It's magic.
And now I'm going to relate this into another story. So I have some money in my TFSAs, and literally it was just sitting there. I hadn't done anything with it. So I decided to buy some stocks. One stock that I saw BlackBerry stock. I know BlackBerry well. I went to Wilfrid Laurier University, so did Kyle. And it was trading near a 52-week low in regards to the value-wise. And I read some analyst reports, and it was indicating that it was a strong buy opportunity. So I bought it. I bought it at $9.50. Then it went down into the I think it went down to like the $8.50 mark. And then it shot up to $10. Literally shot up to $10 last week. And then they announced their earning report. And then it had its biggest single one-day drop. I don't even know in how long. I can't remember. I got to look at what it is.
No.
And when I looked at it yesterday, it's down 25% from where I had bought it at. And even though all the analysts had indicated it was a strong buy, they missed their earnings reports, and the stock dropped in value-wise. Everything, all that, completely outside of my control. I'm sure there's people out there that have done their due diligence on that specific stock and maybe didn't buy it, but those are your Bay Street individuals. For your everyday individual, all the signs point that this was a good opportunity. And then I lost 25% of my value like that in one day. Now, did I sell it? No, I'm going to keep it. It's part of the stock market portfolio. But why I bring up that is that outside impacts, outside technologies, things I don't have control over. What I do know is that when I'm in real estate in the right location, all about real estate, that's why we buy in Toronto, when I'm in the right location, that prices are secure and prices will continue to go up, and I'm not worried about the long-term stability of the product-wise. Cue in the next story for this video-wise. Kyle, when we sat down, I asked you if you read the article. Which article was I referring to?
It was a new RBC article referring to rentals in Toronto and essentially how renters are screwed.
Yeah, RBC did their research and looked at the current rental housing market, which we've talked about before, severe supply deficiencies. But they actually put down in numbers what the severe supply deficiency is, and we need double the rental supply that's currently on the market now to satisfy the rental needs of the Greater Toronto Area. Now, these are fundamental issues. Fundamental market issues. I can't go increase the supply, double the supply tomorrow. These are government policy-based items. These are economic-based items. These are planning department items in the city-wise. There are so many different moving parts that we will not see fundamental change in this for potentially 5 to 10 years, because these buildings still have to be built as well, but even before that, you have to get the policy in place, the economics behind them to get these buildings built. So I know that we have severe rental shortages. I know that we are in the economic capital of Canada in Toronto-wise. I know that we have continued strong immigration growth because this is where the money is, this is where the jobs are, so this is where people are going to be moving to. So why wouldn't I invest in this area? And that's why our last video, was it our last video or 2 videos ago? Invest like a pension fund. Pension funds are buying into apartment buildings. Private equity are buying into apartment buildings. Condos are your opportunity to act like a pension fund, act like a private equity institution, assemble your own apartment buildings by buying condos. If we see fundamental issues in the rental stock, we are turning into a rental-based economy in regards to the next generation looking at rental properties wise as where they're going to be living wise. Then if I just do the equation, why wouldn't I want to buy these rental properties, supply demand issues in the right markets wise? And I've done it. Net worth now is $3 million on the real estate portfolio wise, and I'm not selling, I'm buying, I'm holding, because the market conditions only point in an upward trajectory. Anything you want to add to Kyle?
Yeah, and from my experiences, the best time to buy real estate was a long time ago. The next best time is to buy today.
Great line, great, and it's true. It's really true. And even if there was some sort of downturn, it doesn't matter because you're going to have someone that's paying down all your costs on the property. A downturn in a specific company-wise, that company may never recover. Have you heard of Nortel? Have you heard of Sears? BlackBerry still exists, but it's a fraction of what it used to be.
Yep. Nortel used to be the biggest company on the Toronto Stock Exchange.
Gone, bankrupt. On top of that, with the pension funds as well. But we've talked about that before. So anyways, real estate's going to be there. People need roofs overhead, and the fundamentals are there for it to continue to increase in values wise. And if you look at just a boring 3% compounded annual return year over year, and this is the value of leverage wise, you're going to do fantastic in the long run. And you know what, Kyle? I was thinking about this one on the train ride over here today to the office. What we're going to create, and Kyle hates when I do this, but what we're going to create is a real estate net worth calculator. So people can see and just put the information in, and they can type in the value of their property and what it'll be worth in 30 years, and they can input their own compounded rates. Really easy to do. He has to do it.
But it'll give you guys some inspiration.
Exactly, because I was really inspired when I looked at this. I know Kyle does it. He gets inspired, and you can't look at it today. You got to look into the future wise to understand the full power of real estate. So should we leave it at that?
I think so.
Great, guys. So thanks so much for listening to us again, watching us again. Reach out to Kyle. I didn't even introduce us in this video. I was so fired up.
I know, you're excited.
Kyle, Director of Operations, Remax Wealth Builders Real Estate. Alex, team lead at alexjwilson.com and Toronto penthouseliving.com, helping you build financial freedom and generational wealth. And we hope to talk to you guys soon. Okay, bye-bye.